Welcome back to Finova, where I talk about the latest news and trends in the world of investing. Today, I'm going to discuss about the pre-market trading of U.S. stocks on October 16, 2023. U.S. stocks are set to fall as investors brace for more inflation data. Before we get into the details, please make sure to hit the like button and subscribe to Finova if you haven't already. It really helps me out and motivates me to make more videos like this. Also, let me know in the comments what you think about the current state of the stock market and what are your predictions for the future. So, what is pre-market trading and why does it matter? Pre-market trading is the period of time before the regular trading hours of the stock market, usually between 4 a.m. and 9:30 a.m. Eastern Time in the U.S. During this time, investors can buy and sell stocks based on the latest news, earnings reports, or other factors that might affect the market sentiment. Pre-market trading can give us an indication of how the market will open and perform during the day. According to the article, U.S. stocks are set to fall on Monday as investors brace for more inflation data that could signal a faster pace of interest rate hikes by the Federal Reserve. The article cites data from Refinitiv, which shows that Dow futures are down 0.6%, S&P 500 futures are down 0.7%, and Nasdaq futures are down 1%. These numbers suggest that the major indexes will open lower than their closing levels on Friday. The main reason for this decline is the anticipation of the Consumer Price Index (CPI) report, which measures the change in prices of goods and services purchased by consumers in the U.S. The CPI report is expected to be released at 8:30 a.m. Eastern Time on Monday, and analysts predict that it will show a 5.4% increase in prices from a year ago, matching the highest level since 2008. The core CPI, which excludes food and energy prices, is expected to rise by 4.3%, also near a 30-year high. Why is inflation so high and why does it matter for the stock market? Inflation is the general rise in prices of goods and services over time, which reduces the purchasing power of money. Inflation can be caused by various factors, such as increased demand, supply shortages, higher wages, or expansionary monetary policies. Inflation can have both positive and negative effects on the economy and the stock market. On one hand, inflation can indicate a strong economic growth and consumer confidence, which can boost corporate earnings and stock prices. On the other hand, inflation can erode the value of money and assets, increase the cost of living and borrowing, and reduce the real returns of investments. The Federal Reserve, which is the central bank of the U.S., has the dual mandate of maintaining price stability and maximizing employment. The Fed uses interest rates as its main tool to influence the money supply and the inflation rate. When inflation is low or moderate, the Fed can keep interest rates low to stimulate the economy and encourage borrowing and spending. When inflation is high or rising, the Fed can raise interest rates to slow down the economy and discourage borrowing and spending. The Fed has been keeping interest rates near zero since March 2020, when the COVID-19 pandemic hit the U.S. economy hard. The Fed has also been buying billions of dollars worth of bonds every month to support the financial markets and provide liquidity. The Fed has said that these measures are necessary to help the economy recover from the pandemic-induced recession and achieve its goals of full employment and 2% inflation. However, as the economy has reopened and rebounded faster than expected, inflation has also surged to levels that have surprised many economists and investors. The Fed has maintained that this inflation spike is transitory and largely driven by temporary factors related to the pandemic, such as supply chain disruptions, pent-up demand, base effects, and fiscal stimulus. The Fed has said that it expects inflation to moderate in the coming months as these factors fade away. But some investors are not convinced by the Fed's narrative and are worried that inflation could persist longer than anticipated or even spiral out of control. They are concerned that the Fed might be behind the curve and might have to raise interest rates sooner or more aggressively than expected to rein in inflation. This could hurt the stock market in two ways. First, by making borrowing more expensive for businesses and consumers. Second, by lowering the present value of future cash flows for stocks, especially for those with high growth potential but low profitability. That's why investors are paying close attention to every piece of inflation data that comes out, as well as every word that comes out of the Fed's mouth. They are trying to gauge how hot inflation is running and how soon or how fast the Fed will tighten its monetary policy. The CPI report on Monday is one of those key data points that could move the market significantly. If it comes out higher than expected, it could fuel more inflation fears and put more pressure on the Fed to act sooner. If it comes out lower than expected, it could ease some inflation worries and give more breathing room for the Fed to act later. Of course, there are other factors that could affect the stock market as well, such as earnings reports, geopolitical events, COVID-19 variants, consumer sentiment, etc. But for now, inflation seems to be the main driver of market sentiment and volatility. So what should you do as an investor in this environment? Well, there is no one-size-fits-all answer to that question, as different investors have different risk profiles, time horizons, goals, and preferences. But here are some general tips that might help you navigate this uncertain and volatile market. Diversify your portfolio. Diversification is a strategy of spreading your investments across different asset classes, sectors, regions, and styles. This can help you reduce your exposure to any single risk factor and smooth out your returns over time. For example, you might want to allocate some of your portfolio to bonds, commodities, real estate, or international stocks, which might have different or negative correlations with U.S. stocks. You might also want to diversify within the U.S. stock market by investing in different sectors, such as technology, healthcare, consumer staples, energy, etc., which might perform differently under different inflation scenarios. Hedge against inflation. Hedging is a strategy of protecting your portfolio from the adverse effects of inflation by investing in assets that tend to rise in value when inflation rises. For example, you might want to invest in inflation-protected securities, TIPS, which adjust their principal and interest payments according to the CPI. You might also want to invest in commodities, such as gold, oil, or agricultural products, which tend to increase in price when inflation increases. You might also want to invest in stocks of companies that have strong pricing power, meaning that they can raise their prices without losing customers or market share. These companies tend to have high-quality products or services, loyal customers, strong brands, or competitive advantages. Adjust your expectations. Adjusting your expectations is a strategy of being realistic and flexible about your investment goals and returns in light of the changing market conditions. For example, you might want to lower your expected returns for U.S. stocks in the near term, as higher interest rates and inflation could weigh on their valuations and earnings growth. You might also want to extend your time horizon for your investments, as short-term volatility could be higher than usual. You might also want to review your risk tolerance and rebalance your portfolio accordingly, as some assets might become more risky or less risky than before. These are just some of the possible strategies that you could use to cope with the inflationary environment. Of course, you should always do your own research and consult a professional financial advisor before making any investment decisions. That's all for today's video. I hope you found it informative and useful. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe to Finova for more videos like this. Thank you for watching, and I'll see you in the next one.